Hey folks, welcome back. This is lesson 2, November, or the third month of the ICT mentorship.
Hello. 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 Hello.
Institutional order flow and what makes it easy to see. And we're going to be building a little bit on what we just mentioned in the previous lesson. We're going to be using that euro dollar example. And here's that order block we showed earlier. We showed in the lesson 1. You see the open comes in at 151.97 and the low comes in at 51.45. And the high comes in at 51.51 and 51.43. So very sensitive there. The idea is if we see this on a monthly chart, okay, we can go into the marketplace and anticipate an ideal scenario to unfold in this area here, okay? Now I'm stretching it to the low because it ain't that. Okay, so we have that low, the opening price. As we mentioned in lesson 1, we discussed that there was going to be a high probability of stops below these lows down here. What I want you to focus on is look how the bodies of the candles basically merge at that same general area. I want you to ignore the wicks. Okay, ignore those. And by having that in mind, all below these lows in here, there's going to be a large pocket of liquidity in the form of sell stops. And if we're looking at the monthly chart like this, and we think that there's going to be a high level of sensitivity up here. Why? Because it's already come up and closed in this range by coming up to this level here. And the market is most likely going to trade lower and seek the liquidity below these lows in here. Now, again, for your notes, when we're looking at institutional order flow, the idea is thinking like that market efficiency paradigm. Okay, you're the market maker. So what you're looking for is where is the maximum level of liquidity in relationship to where markets have traded from and where they are presently. Well, the market has traded higher here. So where's the highest level of liquidity from this point here? If it's going to go higher, it would be above here. But we had this void that we closed in. So the market is now rebalanced from a point at which they sold first, it moved quickly away, came back up and closed in that range that created by these down black candles. So the market has delivered price going down. It has to close in that gap by trading it on the upside. So wherever there is a black candle, there must be a green candle. The idea is you want to see where the market will reach for its next level of liquidity. We have the run down here, clearing out these stops. Market clears those stops, and then once it clears those stops right below here, in other words, all this movement over here, all this running of stops, yes, it moves back to a order block, but we're not talking about that now. We're talking about how the market will seek liquidity. The market will run up from this point here because it's already absorbed all the liquidity down here. And yes, just for completeness sake, it's returned back to a bullish order block over here. Down candle rate for the up move. So the market's going to do what? It's going to seek the liquidity on the upside. So where does that reside next? This up candle. That's where they sold the last time. And look, we created another liquidity void. All these down candles. Okay, all black candles down. Okay, so there has to be the market offering on the buy side. They offered on the sell side. So to balance it, there has to be green candles or up candles in this case. Okay, all my down candles are black and all my up candles are green. So we have that same element just repeating itself here, right here. Okay. Now obviously we always look at the middle of the up candle, mean threshold. All my down candles are black. Where does that reside? It clears those stops and then for its next level liquidity. We have the run down here, clearing out these stops. Market clears those stops, and then once it clears those stops right below here, in other words, all this movement over here, all this running of stops, yes, it moves back to a order block, but we're not talking about that now. We're talking about how the market will seek liquidity. The market will run up from this point here because it's already absorbed all the liquidity down here. And yes, just for completeness sake, it's returned back to a bullish order block over here, which is the down candle rate for the up move. So the market's going to do what? It's going to seek the liquidity on the upside. So where does that reside next? This up candle. That's where they sold the last time. And look, we created another liquidity void. All these down candles. Okay, all black candles down. Okay, so there has to be the market offering on the buy side. They offered on the sell side. So to balance it, there has to be green candles or up candles in this case. All my down candles are black and all my up candles are green. So we have that same element just repeating itself here, right here. Okay. Now obviously we always look at the middle of the up candle, mean threshold, and you can see how the bodies of the candle respect that. There's always going to be this extra little run on price with the wicks. Okay, and I've mentioned this in many instances over the last 6.5 years teaching Forex online. You're going to have to allow that erroneous price action where it will run farther than you probably would expect it to because of your broker. Okay, so they allow them to open the spread up a little bit more. So when price trades up, it hits this area of liquidity. Now where we're going to be expecting to see price trade to. Well, the largest area of liquidity was going to be resting below these lows, right? Or this low rather. Look closely. Just like we showed over here with the bodies of the candles, okay? We're going to look at the bodies of the candles here. Okay? So, classic technical analysis, what we'll say, well, this wick is the low. And what I teach is it's the bodies of the candle is where all the volume is. The institutional volume. There's a difference now. The wick is always going to be directly related to retail. Okay, retail stops because we're looking at a retail platform. Most instances, you're going to see the wick is generally comprised of retail pricing. All of the bodies close to the interbank prices you're going to get. So we allow provide us a erroneous price delivery or extreme price delivery. But we want to do most of our analysis around the bodies of the candles. So what does that mean? It means that if we have the bodies of the candles defined here as the real low, and allowing all this to be viewed as retail, if we scrub that over to here, you see how price trades just below the bodies of the candle, as it would in terms of seeking the truest form of volume from an institutional order flow standpoint. If we're not going to break the range on this run here, and we'll teach about that in the mentorship, but for now, we expect it to close in the range here. Just as well, we saw this up candle here, this down movement, price comes up and closes in its range here, and it runs for the liquidity below here. The point of what I'm showing here is once you understand where the market will most likely reach for, and this is a monthly chart, now we can take a step back and say, okay, if I can define the market in terms of, and we'll say, for instance, say we were lucky, okay, we were really plugged in, we were studying, and we felt that this market was topping out up here, okay, and we knew that once this low was violated here, we would have a potential range of that. Clearing out this consolidation, stops will be resting below that, okay, we would see reasonably expected to run through that. We also know that we have a bullish order block right here. Now notice it wicks through that, but the body of the candle, this candle's body rather, trades right into this candle here. Okay, so that's all it's required to trade into bullish order block. Now it's a monthly chart now, so we can expect some expansion through and to run the liquidity out here. Look at all the wicks. Okay, the wicks are no significant barrier in terms of institutional order flow. We just know that there's going to be a large reason to expect stops resting below the wicks, or inside the wicks, let's say it that way, but below the bodies of the candle. Okay, so what we're seeing is we're seeing another area at which we have price trading from the bodies of the candle. We drag that all over here. You see price trades into that area right in here as well. So it's seeking liquidity below all these bodies of the candle and the wicks and recapitalizing this order block here. You see the bodies of the candle, look how it's respecting that. All the bodies stay above this candle's bullishness. Now, we would reasonably expect to see price trading down to that level at that point. If we see this willingness to want to be recapitalizing this bullish order block and we clear out the stops, next area would be what? To see price reach up into the void, which is up here. So we would see price want to reach up and capitalize this price level. So we have an
Hi, Izzy. So it's a core content. Month 3, second lesson, core content.
institutional order flow is bearish. So we get down to here, and what it's going to do is going to look for liquidity on the upside. This is the area which you would expect to see price that want to run up into. So as price is rallying up, it's trading down to that level at that point. If we see this willingness to want to be recapitalizing this bullish order block and we clear out the stops, next area would be what? To see price reach up into the void, which is up here. So we would see price want to reach up and capitalize this price level. So we have an area at which institutional order flow is bearish. So we get down to here, and what it's going to do is going to look for liquidity on the upside. This is the area which you would expect to see price that want to run up into. So as price is rallying up, this is all bullish. So institutional order flow is bullish here. Then once it gets to this point here, we're looking for what? The stops below these lows here. So we would see institutional order flow swing to the downside. Now notice what's happening again. The bodies of the candles, it's violated with this down candle here, and clear out the stops. Okay, and again, we mentioned that it's rechasing back into this bullish order block. From here, where would we reasonably expect price to go up to? Again, that's this bearish order block. So you want to see price reach up to here. So in this instance, we would expect to see what? Price rally up into this area. So all through here, institutional order flow is bullish. Now I can keep doing this back and forth, and show you example after example. But what I'm showing you is from a monthly standpoint, you take the information I'm showing you here, and by example, here's the bodies of the candle, not the wicks. It stabs through it. It'll go below the bodies of the candle. It doesn't necessarily have to go through the wicks. We only need it to reach below the bodies of the candle. Okay, so while we have
No, easy. I have just stopped trading GT like long time ago. I've just stopped trading GT strategy.
so it's bearish when it's in the red area. Okay, all we're going to do is internalize the marketplace like this. So if we have it set up like this on a monthly chart, all we have to do is break the market down into a weekly, just changing it into a weekly chart. Okay, so now we have the price shown in weekly basis. All through here, we have the market in selling condition, market's in a bullish market condition, bearish market condition, bullish market condition, bearish market condition. Okay, so now what we've done is we've mapped out this entire euro dollar from mid 2008 all the way to mid 2012, just by understanding what the monthly levels on institutional order flow will give us, and understanding those points of reference I showed you in September. What to focus on is that's the recipe for all the trading you're ever going to want to do. That's it. That's the secrets. Okay, but you have to find them on the higher time frame and arrive at where the higher time frame charts are going to seek liquidity, because this is where the large funds have their money, and where the large money is found on the fund level, that's where the bank's going to reprice to. It's not for retail people because they're too small. If we're selling, we're expecting bearishness in here. Okay, this decline, see the retracement back up into, and yes, it wicks through, but the body of this candle is where you'd be looking to be a seller. This wick never violates this up candle. So we have a bearish order block, we trade to, and expands low. Price creates a down candle here right before this up move, in a time where expected institutional order flow should be seeing price move up into that bearish order block. Right here is where you expect to see buying in an area at which bullish prices should be expected, until it gets to this level here, which is that monthly bearish order block we showed on a monthly chart. And price would be reasonably expected to go lower, to seek the stops below these candles down here, the bodies of these candles. See here. But look how the market provides us an opportunity of real crystal clear delivery of price, where we see price repel, it breaks down. Okay, when does it become apparent that it's going to go lower? See this candle here, 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 here. This last up candle, that's the last green one. And that candle's violated right there, right here on this black one. Now you're going to be expecting price to expand on the downside. Price does it here, trades a little bit lower, and we have a small little retracement higher. What's it trading back up into? This down candle, which is a breaker. Was it breaking the highs here where the initial sellers would be having their buy stop resting? And then we clear those out and go lower. This down candle is where they're going to populate new selling. There, you can see them selling right here. So they're mitigating the longs they use to buy the price higher. They take those orders off, and then you see the acceleration going up. All this area in here, okay, we have an up candle, down move, retracement back up into what? What is this? Block. With this bearish order block, okay, bearish order block right in here, trades up into, and immediately sells off again. What's institutional order flow reaching for? Stops below here. But why is this signal forming here? Why is this pattern forming? Because it's undoing the buys that was used here. Remember, the down candle is a bullish order block, and they should be buying there, and it does. Look at this, boom, explodes. This sell is unwinding the longs they put here. Everything is a hedge at the interbank level. Okay, when you've seen price move from one level to the next, there's all buying and selling going back and forth in between those two range extremes. Range extreme down here, range extreme up here, and there's another range extreme here, another range extreme here, another range extreme here. Okay. So in between these two extremes, there's going to be hedging. There's going to be bookmaking where the bank can have a net bearish book here and be making money as it's going lower, but they have to be buying too. And while they still may see price going here and selling, they have to take the orders off that they used over here that are long. That's why we're seeing that unwinding right here. Everything is going to be on the opposite side. Go over to the left side of the chart, and you'll see whatever they did to go long, they're going to take that off on the sell side, and which is the basis of a market maker sell profile, which is what this is. Consolidation, return to consolidation, accumulation, smart money reversal, low risk short, and redistribution, another redistribution, and the market reaches below the consolidation, and you're taking out those stops. Once the stops are cleared out, they're going to look for another layer of additional order flow for the opposite side. So it's going to be in the form of the return back to this bearish order block, which we showed in the monthly chart. Market trades up into that level here, but between the point at which it hits here and once it creates the run on the stops over here, we would be in a bullish institutional order flow environment. So we would expect to see the market trade back into down candles to be rebought. In other words, new buying should be seen here. This down candle right for the up move, you can see the price in here. Two candles wicked down into this candle right here. From the high down the middle of the candle, it wicks into it here. And this is kind of hard to see, but that candle's low comes in at 21.51. 21.51 is below this candle's low, so it's down. You see that's what right there's the low. It's inside this down candle. It's buying and expand price higher. Then we have a retracement. Okay, price retraces, trades into what? This up candle. So what's this? They sold here. That last up candle is they sold. Why did they sell there? To drive price below these lows in here. So there's your run on stops. So the up candle they used right here to get sellers below the marketplace with their sell stop. Why would they want the sellers? Because their sell stops come market was to be a buyer. Counterparty too. So it's the sell stops below these lows. They will activate them and buy them. Smart money will buy it up. Once price trades through that, it'll come back down and trade right back into the last up candle. Why are they doing that? Because the shorts that they have on, they have to take those off and mitigate them. So this wick down to the body is a mitigation block. So price comes down, hits that level here. The shorts that they used when the price was going up, remember smart money sells it was higher. They drove it lower to run the stops. Price trades through that candle right here. But their orders are underwater now as it's up here. So when price comes back down, trades in that same range from the high down to the bottom of the candle, they can take those shorts off and buy them. And then you're going to see explosive price action. Why? Because it's going to be buying a cover on shorts that are here and then buying more for new net long position. And you'll see expansion aggressively, and you see that here. So now you have down candle right before the up move. In a time when institutional order flow suggests prices should be bullish, or in that shaded area, price trade down into the bullish order block, new buying should take place and expand up. Now, when we've seen buying down here, or would expect buying in here, the reasonable expectation would be to see price trade up to this up candle first. That's your first objective. Then above this high for stops, then expansion up into closing in this range here into this bearish order block, which is the last up candle. Comes back down, buys, bullish order block, expected to run through here and back up into the monthly bearish order block. And it does that handsomely here, sweeps it out. Then we can see what? Price break down again. How do we know it's going to be bearish? Because it breaks the last up candle at an area where we would expect to see bearishness. Breaks it here, it comes right back up. At the bottom of this up candle, retraces to it. You can be expecting downside movement in price. Price starts to break lower. One more time, retrades back up into this bearish order block for good measure. Breaks down. Now it's going up. It's going to go lower. Trades up. One more time, works that same bearish order block here. Finally gives up the ghost and trades back up into this high here. Price rate trades lower. Reaches for the liquidity below here. Below the bodies of the candles over here by reaching down. And then ultimately reaches below these lows and back down into the bullish order block right over here, which is what we're seeing here. So if you start with your monthly and you break down into the weekly chart, we can go down to a daily chart now. You see a lot more definition on the daily chart. Bullish candle, which is the bearish order block, because price drove lower, retrades right back into the bearish order block right here. Bodies respecting the middle of that up candle, fell off. Market creates bullish order block, rallies through, clearing short-term highs, retreats back down into the last down candle, bullish order block, rally, down candle, propulsion candle, rallies up, small little drop down, hits the exact high of that candle here. High comes in at 28.02. The low on this candle comes in at 27.95 into this body's candle. I'm sorry, this candle's body. Rallies all the way up into bearish order block. Now again, we're in a blue shaded area, so while on the daily chart, it's dropping lower, 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 lower. The institutional order flow on the monthly is telling you to get ready for buy. So we get down to these levels in here, expect to see some buying, but we have to wait for price to want to show a break above the short-term high. We see that short-term high violated here, so now we know buyers are in the market again. Wait for it to come back down into that monthly bullish order block. We see it trading here. But now look what happens. This down candle here rallies away, comes right back down into it now on a daily. Is a daily here? It's that bullish order block, and then look at the reaction. It expands quickly. Now we have this down candle. Draw that out in time. Buy here, rallies up. This down candle. Keep following institutional order flow. The high is 34.36. The low is 34.23. Right into this down candle again. Buy it again. Boom. Explodes. Keeps going higher and higher and higher, goes into consolidation. Every new buying finds a down candle. You go right back to the previous down candle here. Buy it again. Price rallies again. Price dips back down into what? This down candle here. Buy it again. The down candles in here, all one order block. Halfway point through that. Right there. Boom. Buy it again. Rallies through. Keep in mind of the monthly and weekly order blocks, as we're seeing it again in here. You see the response, boom, it rallies. That's why you don't see anything over here. Notice there's no bullish order block in here. There's no any kind of point at which you would see, oh, this is what that would be. No, it's found on the weekly and the monthly. That's why you see this response here. Price rallies away, comes back down, trades into bearish candle, which is the bullish order block. And then this would really get it traded right into below 46.26 into this order block right here. It rallies again. You can see the shaded area we had again from the monthly. It rallies again, explodes up into monthly bearish order block. Last up candle here. This one, when it violates that, does it here. Expect to see bearishness. Wait for it. Boom, it breaks. So when price breaks down, you're going to be waiting for a return back to either a breaker or a bearish order block, or you can look for a stop run on an old high. So we're in an area where we'd expect to see markets continuously moving lower. On the daily chart, we can be using all these old lows to see price reach for them or expand down. So institutional order flow is suggesting lower prices. especially from the monthly and the weekly. Now we're in a daily chart time frame when the institutional order flow should be weak or bearish. When the market creates a return back into a monthly order block here, it becomes a mitigation block on the daily chart, because now we're unwinding what was used to be bought here, which is a breaker. What is it breaking? This old high. That's why we're seeing it right here. You can clearly see it happening here on the daily chart, but it was seen on the monthly and on the weekly. All through here, this red area, every single time the market creates a new bearish order block, or if it creates a run above old highs, we see the old highs here, through them, sell off. Old highs in here, runs above it, sell off. Old high here, runs above it, sell off. And we also have bearish order blocks. Last up candle right before the down move, sells off. Last up candle before the down move, retreats back to it, sells off. Last up candle, even in this sloppy mess, right to the bottom of the candle right there. Well, now we're in a bullish area on institutional order flow. And you would expect to see all these levels which are being found on the monthly and the weekly. Look at the sensitivity that you see on the daily now. And the last down candle here, ready for the up move. Price trades into it here, and it's on a higher time frame order block. Down candle here as well. Buy again. Buy it again. Price explodes. Look at the sensitivity right there. Again, this level was arrived at on the monthly and weekly. Look at the responsiveness you see in price. And what's it reaching for? We'll put it up over the old high. And a bearish order block on the monthly. So what you're doing is what institutional order flow is. It's the seeking of large institutional liquidity. That's going to be found on the monthly and the weekly, and you see that being traded into on the daily. That's why it's on the daily chart. Again, this is why we're looking at daily. The daily chart will always seek the fund level institutional order flow. In other words, the stops that are found on monthly and weekly charts. You're going to see all your signals that have the greatest magnitude, the biggest moves that take place are always going to be found on that monthly and weekly basis, because that's where all the large whales are. Okay, when I say whales, I'm talking about big funds, large funds, okay? And when they have money at risk, that's where the market's going to go, because that's orders that they can counterparty with. The banks cannot counterparty with you and I. We're just not big enough. Even collectively, we're not big enough. But the funds, because they're controlling billions and billions of dollars, and that's where the money's at. So if you can find the levels on the monthly and weekly chart, keep them on your daily chart, you'll be able to see all these major shifts in price that sometimes jump off at you after the fact and you wish you would have known they were coming. Now you know how to see them by transposing them from the monthly, weekly into your daily chart. If you do your trading around these levels, you will see every significant price swing that ever transpires on price. You'll see them coming before they get there. And you'll also know, relative to institutional order flow, where the stops for liquidity is above the marketplace. When you're ready to buy, or when you expect a bullish scenario to unfold, you'll already know where the market should be reaching for, should it take off and start trading higher. When it goes up to a level of resistance or some kind of bearishness, before you even sell short, you're going to know where it's going to be reaching for, which is a sell stop below the recent lows or a bullish order block. And by having that idea how the market will continuously look and seek liquidity, it's not our liquidity, it's not our stops it's looking for. It's looking for the stops found on the monthly and the weekly and daily, because that's where the whales reside. That's where the large funds reside. And that's what pushes price around. Understanding that that's why the market will go to these levels, because it's wanting to take those participants either out of the marketplace or draw them in as counterparties to their intended purpose. Either being a buyer, counterparty to sell stops, or to be a seller, counterparty to buy stops. And that's the nature of institutional order flow. So with that, guys, I wish you good luck and good trading. Okay, folks, welcome back. This is lesson 3 of month 3 of the mentorship. We're going to be dealing with specifically the institutional sponsorship and how to identify it in setups. First, we're going to look at the institutional sponsorship in long setups. Key to identifying institutional sponsorship in long setups is the notation of a higher time frame price displacement. And that can come in the form of a reversal, an expansion, or a return to fair value. Intermediate term imbalance in price. Now, this is a move to discount or a sell-side liquidity run. In other words, the price. Retrace, or it can begin by going below an old low to run out the sell stops. Once one of these two occurrences appear in your chart, the next thing you'll be looking for is short-term buy liquidity above the marketplace. Now, this is going to be ideal for pairing long exits to sell to. And obviously, you're going to be looking specifically for a time of day influence, i.e. London Open for the low of the day or a New York session low formation. Now, it's important understanding that number 1 and number 2 are the criteria, which sets up the expectation for institutional sponsorship. Then we see the actual institutional sponsorship come in by way of attacking the marketplace for the buy side liquidity that would be resting above the marketplace. In other words, we have buy stops typically above old highs when we're short. The assumption is, and again, I teach the role-playing model that gives us the perspective of a market maker. So you have to have that market maker perspective on price. So we look to sell high, but we have to find buyers that are willing to buy it higher from us. So the criteria is we have to look for short-term buy liquidity above the marketplace. Now, it's going to be layered buy stops throughout the marketplace because there's all kinds of trading that goes on. It's long-term, swing trade, short-term, day trading, scalping. But you have to look at the higher time frame for that short-term buy liquidity to give us a framework to see if there is, in fact, institutional sponsorship in your setup. And obviously, you'll see these characteristics come to fruition by studying the time of day influence. Now, obviously, you're not just studying it. Eventually, you're going to be actually trading in the marketplace at these specific times of the day, London Open, New York session, London close. and sometimes Asian. And obviously, the opposite would be for institutional sponsorship in short setups. We would be looking for, again, much in the same way we saw for the long setups, just in reverse, higher time frame price displacement. And that's going to come by way of a reversal or expansion or a return to fair value. And an intermediate term imbalance in price, that's seeing the price move to a premium or moving towards the buy side liquidity, make a run on the buy stops. And then short-term sell liquidity below the marketplace. This is going to be ideal for pairing short exits to cover. And obviously, those sell stops will be buying those from the counterparties in the marketplace. And just like we did with the long setups, we would be looking for time of day influence, i.e. London Open high of day or New York high formation. Now, in this specific teaching, we're all going to be dealing specifically with the institutional sponsorship seen in long setups. Everything you see in the example will just be reversing that for the criteria used in the short setups. Okay, we're looking at a higher time frame chart. Okay, just for disclosure's sake, this is a Japanese yen, US dollar versus yen. And we're looking at a daily chart of that particular pair. And I gave you an ideal scenario where we can study a sample set of data. Okay, and it's not cherry picking. You guys can go through charts and actually see some of these things that come to fruition many, many times. But the criteria is for our setups to be high probability, we have to have institutional sponsorship. Now, what is institutional sponsorship specifically? It's the willingness to protect an underlying price swing that has high probability of unfolding. Now, I'm going to outline that throughout this entire teaching, but I want you to understand that simply institutional sponsorship is just the impact of large institutions, banks, and big equity traders coming in to fund the side of the marketplace that you anticipate seeing it run towards a particular side of the marketplace. For instance, if we're looking at a buy setup, we're going to be measuring and trying to identify characteristics that lead us to the assumption and ultimately an understanding of institutional sponsorship as a concept, so that way we can go forward in our trading and start looking for these fingerprints that are many times repeating over and over again when we use higher time frame setups. Now, looking at this daily chart, you can see it shows price dropping down below an old low. This is typically where sell stops are going to be residing, or as we call it, a liquidity pool. Sell stops will pull below this old low, and everyone that would be wanting to go long, they would have a sell stop right below that. And in fact, because everyone's doing that same idea of putting a sell stop here, that's where the idea of a liquidity pool. All those orders are pulling together, okay, and creating a pocket, if you will, of selling interest. Now, it doesn't mean that they want to go sell short. Okay, some folks out there would see that as a particular interesting level to be short at a later time. Should we break below it? But in this case, when we see a price run like that, we obviously have to assume, again, it's that market efficiency paradigm again. Participants are looking to protect long positions there. So it's not that they want to get short, they want to get out of the long position. So if we ever see a price move, the sell stops are ran out. Now, an aggressive trader, they can see this as an opportunity to go into a lower time frame as that low is violated here, right on this candle here. You can go into a lower time frame and look for a similar pattern. This price is fractal. That means everything you see on one time frame is replicable on the higher time frame and the lower time frame. So in other words, it's going to have a lot of similarity throughout all the time frames because price is still what? Price. So you can look into a lower time frame and actually study the price action and come to basically the same idea you're seeing here, an old low that we would wait for short-term price action on a lower time frame to create that same scenario, which is a low being violated because everything on price is fractal. By having that understanding and expectation, we can take a long position, but we're going to go one step further. We're going to actually start looking for evidence of institutional sponsorship. Now, looking at this setup, okay, what's the first thing that comes to mind for you as a trader? Obviously, going back to September's content, there are some things I told you to look for in terms of studying price action. What should you be focusing on? Well, if we're anticipating a market move higher from down here after a run below the old lows, we start looking for, okay, where could this market go to? Well, we have a short-term high here. We have a short-term high here. Look at this big candle here. Wonder what that's going to suggest to us. And how about this old high back here? We have a nice price move here. Price could ultimately go back up here, or it could just come in this area here, close in that range, or come up and clear these relatively equal highs. Remember, the things we talked about in September, I gave you as bullet points for you. As soon as you go into a price chart, those are the same things you look for all the time. They're not changing, not morphing. It's the same premise every single time we look at price action. But looking at what we see here, prices forming a potential bullish order block. Now, this old high here, obviously we know what's going to be resting above that. It's going to be buy stops. Well, we have a last down candle here. Price is now reaching into that right here. And it's also dipped one more time into that area right below this old low. So we did one more time poke our head just below that level. So we can anticipate now some sensitivity and protection of seeing the price not go lower. That's what we're anticipating. So if we see that, we're going to see what? Characteristics of institutional sponsorship. That means the banks are coming in and they're capitalizing that old low back there. That means they're buying it again. Notice again that range up here. What is that? It's a liquidity void. So inside this liquidity void and above this old high, what do we have up here? This is called buy side liquidity. That means there's a willing participant or pool of buyers up there. Okay, so when we start talking about open float, we'll be referring to a lot of these ideas as well. But open float can be a little confusing because it's relative to the time frame you're looking at. So while we're working on high time frames, I'm just going to focus primarily on classifying this as what it is to buy side liquidity in the marketplace. So as a market maker, they see these opportunities to sell, to run the stops that are below this old low, below an old low to take the sell stops. What is that implying? They're probably accumulating those sell stops in the form of taking the buy side of it. So if they're willing to buy those sell stops up, that means they're primarily building a net long book. And if we have suggestions in the marketplace in the form of price action, suggesting that we have buy side liquidity in the form of a liquidity void and old equal highs back here, we may see, in fact, a very easy, low risk, high probability trade scenario to be long. And obviously, we see the results of price later on takes off and fills that void in. Now, by itself, you may not have caught that trade. You may not have seen this trade. You may not have seen it as we're describing here, because obviously we have the benefit of hindsight. But let's assume for a moment we're going to go through the characteristics of what we just outlined in the beginning of this teaching. What we have to look for is higher time frame displacement in price. That's what you're seeing right here. This is higher time frame price displacement. That means there is clear evidence that there is a large entity entering the marketplace. And the reason why we know that is because if this is a daily chart, daily charts are not going to move that dynamic without sponsorship behind it by banks or large institutions or big equity traders. Again, the reason why we focus on the daily chart is because that's where the banks are trading off of. Those levels are key to those institutional level traders. So when we see this, obviously we have to go back to where did that move begin? Yeah, everything has to have a origin. So we go back to the beginning of that price swing. That higher time frame price displacement has to have a root price level at which we can classify as an institutional sponsorship level, where everything started from. So if we can arrive at that, we can break down the marketplace and wait for another opportunity should it get down to that level again. That comes in the way of this order block right here. that last down candle. We're using the body of that candle here, not so much the wick, because the wick is basically the body of this candle as well. Price comes down and hits that level. Now, again, to identify institutional sponsorship in a particular segment of price action, you need to see immediate dynamic response. If it's lethargic, if it's not willing to move right away, that means there is no institutional orders in that area. So therefore, if you're in a trade and you see that lackluster activity, the first thing you should be thinking is either reduce risk, cut the position in half, or just completely bail on the trade. You can always re-enter it another time. You can always go back in on another continuation pattern. But do not force yourself to come to marry a idea that it has to be just because you entered the trade and the trade idea doesn't show you evidence that it wants to move in your favor dynamically. Don't ever regret or feel bad about wanting to collapse that trade, because even if it moves in your favor after you collapse it, if you have the characteristics that we're describing here in this teaching in your trade and you start seeing it, chances are you're probably not in a good mood. Okay, if you're on the right side of the marketplace, the market's going to move dynamically immediately as soon as you get in. If you are offside, you're going to see either the market hauling him back and forth, stalling, and then ultimately reversing on you. That's the worst scenario. I'd rather have my losers be immediate, show me that there's evidence that I'm on the wrong side of the marketplace and I'm offside. But sometimes it won't happen. Sometimes it'll be really lethargic and they'll start to squeeze on you slowly, and then just about when you realize you're on the wrong side, then they'll accelerate towards your stop. Or if you don't have a stop, it hurts worse. But that's why we use stop loss orders. But when we see this sell stop low capitalized by this buying in here, okay, we see this higher time frame price displacement. That means the elephant has put itself inside that pool. I did a teaching on my tutorial page where I kind of gave you an analogy where if you had a small children's swimming pool in your backyard and you filled it up with water, and an elephant stepped inside that small children's pool, what would happen? Obviously, one of two things. If it's an inflatable pool, it probably would collapse. But if it could withstand the fact that the elephant was in that small children's pool, the fact that the elephant getting in that pool would displace the water. It would rise up above the brim of that pool and overflow. And that's what we're seeing here. This is the evidence of a large body or entity that has a lot more money than us, and they got into the marketplace here. How do we know that? Because the price surged. And again, this is the daily chart. So if price can get back down to that level again, price should see a responsiveness on the upside. So we're going to start looking for signs and evidences of institutional sponsorship there, because we already identify an area where price should see return to buying again, because it had a strong willingness to want to be bought up at this level here. So we're back down to that level again. So we should see upside momentum, or if not for anything else, a short-term bounce that we can actually trade and take some profits off of. So focusing on this bullish order block here, that's where the institutional sponsorship is going to begin. And it comes in the way of a bullish order block. So we have this idea, and we take this information, we can transpose all these levels down to a lower time frame, but I'm going to build on this idea with this time frame here. So we got 1 and number 2 of the criteria when we're looking for institutional sponsorship. We see higher time frame displacement, and we see price trading back down into a discount and closing in, basically returning to a fair value or back to an old area where it was bought up the last time. The next level is where's the short-term buy liquidity? That means the buyers that would be above where current price market is right here. This where we're assuming the price would be at the time. Where would be the logical area where we'd expect to see the banks want to unload those long positions? If they're going to buy here, where would there be a ideal scenario for them to want to sell those long positions? Well, we have a short-term high here. We have a short-term high here, but we also have this old swing high back here, which was the midpoint of this overall price swing here. Okay, so we had a consolidation, accumulation, price explodes, okay, and it reverses up here. It comes back down, back down to the area which it was bought up again. If we see a willingness to go up, we have to take our position off at logical areas. So we want to see the willingness to see the market rate run back up into these highs here, run those buy stops above the short-term high, and then ultimately we want to see this high as well, retraded to. Now, if the market can come back above this old high here, that's showing willingness to do what? Hold for higher prices. So if they're going to hold it to this level here, where would be the next level on this chart you consider for unloading long positions by the banks? Well, above this old high, there's buy stop liquidity, obviously, as we noted earlier. So above the marketplace, we have buyers that would be willing to buy up here because why? They have a short position here. And again, it's that market efficiency paradigm. You have to think in terms of the market as the market maker. So there's going to be buyers up here. So if you're going to be a bookmaker, okay, at the bank, and you're buying and you're net long on your book down here, you want to unload where? 10 pips, 15 pips up? No, obviously not. You can't move your positions in and out. You're controlling such a large book and a large equity base. You want to get it out of up here. Why? Because there's going to be a pool of buy stops up here that in the form of protecting short positions, there's a large degree of buying interest because of that very nature of what we're seeing in price. The market has traded lower. They've trailed their stop loss to just above this high here, just above this high here, and stubborn or very strong-willed bears will have their buy stop protection right above this old high here, or their protected buy stop for their short positions would be resting just above that high, basically. So if you're going to be buying down here like a bank, you're going to be looking for the move to go up to here. And price obviously goes up there and hits it. Now, here's the thing. As price hits that level right up there, what's it doing? It's pairing orders with buy stops. So that buy stop liquidity is gone. So what's the next level of institutional order flow? Suggests price may go to that old high back here. And what's resting above that old high? Buy stop liquidity. So now think for a moment. We have a daily chart here where sell stops were ran out. Price was willing to go higher. Came back down in that same area here. They bought it up. Ran an area of buy stop liquidity. And we have an old high back here still. If it's going to go up here, that means it's going to be highly unlikely for it to come all the way back down to this level. Again, why would that be unlikely? Because we've seen this low here and it rallied higher. We've seen this lower low here that went below this old low and it rallied up. We came back down to that same level here and they bought it again. Now this time we were able to move above this old high. So market structure on the daily chart has now changed to bullishness. So if we see this, the whole premise behind this teaching is institutional sponsorship should protect price from ever coming back down into this area here. So don't think just because we rally up here, let's go back down here and let's wait for price to go and give us a buy signal here and then get us a ride up to that level up here. No, that's not how it's going to happen. We've already cleared an area right here, this old high, and now think. If we were trying to buy here, okay, and our ultimate objective would be to take our profits up here, if we grade that swing, this would be origin, this would be the midway point or equilibrium, and then terminus would be up here. So there, inside this little section of price action would be the first grade of that price swing. This is equilibrium or midway point. Then there's going to be something up here, probably, before we get to that level, and then ultimately up here, terminus. So we have 4 stages of that price swing to identify. And institutional sponsorship should support price at those logical areas in price. Down here, usually it's pretty quick. They don't want to get you an opportunity to get in there. Okay, once it takes off, then you got to look at the equilibrium price point of the overall price leg you're trying to capture. In other words, we're trying to buy down here and get off our position up here. So we're trying to buy down here and sell to the buy stop traders up here. In other words, anyone that's bearish that have a buy stop above here, Or do you think this market's going to be a breakout candidate if it gets above that high? Those buy stops are our target. But in here, we do not expect to see price come all the way back down to this level because we've already seen it trade from this level here, this level here, this level here, and now we have market structure breaking on a very intermediate term basis with this old high being violated here. So now looking at this, we can see what? We have a down candle in here. Price has already moved to the midpoint of that candle right there. Even though it's a down candle, this is an opportunity to anticipate price doing what? Being protected here. So institutional sponsorship, okay, should be identified in this area here. They should not see price come lower. And if we see that, then it's going to be a high probability the market's going to want to reach up for this level up in here, which is aiming for these old buy stops. So we're going to take a look at that whole thing in the form of a 4-hour chart. As price came down and hit that level here and gave us that same fractal idea, trading below an old low, okay, because that's what we saw on the daily chart. Price goes just below that old low here and rallies off. Now, think for a second, what's actually occurring here? What's actually happening? What's this right here? What's these two down candles forming? Well, it's dropping price, but it's dropping at a specific level. We're going into a higher time frame support level. What's that create when it does that? It's a bullish order block. It's down price with down candles at an anticipated level of support, or where we expect to see institutional order flow send price higher. So in other words, we're anticipating that bullishness in price. Obviously, we have buy stop liquidity above that short-term high, and ultimately we have those buy stop liquidity resting above the high that we were just mapping out earlier. Each time the market goes up and takes out a level of buy stop liquidity, we don't collapse the trade entirely. We don't look for reversal patterns. We do not look for divergence in indicators every time we get to an old high here. We're looking for a willingness to keep moving higher to run these longer term buy stops. As price takes that first level out, those buy stops are gone. What's missing now? The liquidity in the form of buy stops above that short-term high. So what we'd be expecting to see is price continuously look to go higher to go after the what? The next level of buy stops, and that comes in the way of those old highs here. But not losing sight of the buy stops above that higher high. Price surges higher, runs through, takes out the second level buy stop liquidity. Now notice what's happened here. While it was a dynamic surge through that second level buy stop liquidity, it fails to go back to that old high. This is classic price action. Now think about what we talked about earlier. We had the original point of which the price swing began, or the origin. Then we have the first area, or the first scale of that price swing in here. Then price goes up, and now we're getting just about to the point at which the equilibrium price point would come into in formation for analysis. We would look for the fact that price has an unwillingness to go lower. That would be evidence of what? Institutional sponsorship. In other words, we're not seeing them allow price go lower. That's basically all I'm saying in clear terms. So again, those buy stops are gone, and we're focusing primarily on the moves justified by price action. Is it going to still go for those buy stops above? And ultimately, it runs up and snaps through that old high. You can see price ending that at turns. But notice what we have here. Price has moved in grades, and it has moved up into what would be deemed as equilibrium on the daily chart. So let's take a closer look of why this was such an easy expectation and how institutional sponsorship could aid you in your price action study when you see buy-side liquidity as your targets. What things should we see in price action to help support these ideas? We're going to take a look at this in the form of a lower time frame chart. Again, outlining why the buy-side liquidity is ran out. Okay, we're looking at a 4-hour chart of that price swing. You can see the price swing here, high, that's this move here, this whole price swing. And we're going to look at institutional sponsorship throughout the entire price swing. You probably already noticed there's some blue line segments on there. So we're going to start talking about some super secret sauce. We're looking at now a 60-minute chart. And I want you to take a look at the reactions that happen from the blue line segments. And I want you to look at it real close. Those blue lines are one of the coolest things I discovered about price action. And not only is it indicative of what future price direction may be, but it also gives us prognostication for future setups. It doesn't just give us a right now what should be support or resistance. It gives us a future prognostication for where setups may unfold at a later time. Let's zoom in a little bit, okay? And I'm going to add, again, the levels on those short-term highs, and we're going to note them as the old highs. So every time you see that little gray horizontal line segment, what we're actually drawing your attention to is these old highs here, and that's going to be in the form of those old buy stops. Okay, so again, you see those gray lines here, and all that's doing is just delineating those old highs in the form of price. Now, I don't want you focusing on price numbers or anything like that. I just want you focusing primarily on price action alone. The delivery of price is all we're interested in talking about specifically for this teaching. And we have the beginning of the move here. Price trades down, back into. Now, this is the run below that previous low. So we see price making that low, and then we see a reaction. Then we see price trading lower. Okay, all these down candles is building what? That 4-hour order block. Okay, it's a bullish order block beginning right there. So that high, when that candle begins the order block, that would be deemed a bullish order block on the 4-hour chart. But because this is a smaller time frame, we're going to have a lot more candles, obviously. So I want you to take a look at the blue line segments. Okay, what I'm delineating there is the opening price at midnight in New York. Okay. If we suspect that price is going to be bullish, we can look at the opening price at midnight in New York. And if we're expecting a price move higher, what we see in the form of institutional sponsorship is price when it goes below the opening price at midnight should be accumulated. So here's the opening price later in the day, New York. Price trades higher. Okay, here's the opening price at midnight the next day. We're not concerned about the movement above it. We want to see what happens when price goes below it. Okay. Now, obviously, going below the opening price here, we have what? What's all this? This is a liquidity void. Okay. Price is going to do what? Return back down into Price does what the very next day? It opens, trades lower, and does what? Rallies. The next day we open, we trade lower, and then we rally. The next day we open, small little move below the opening price, and institutional sponsorship steps in again and sends price higher. The next day, the opening at New York's midnight candle, trades lower again, and what happens? Institutional sponsorship steps in one more time, and they buy it again. Rallies up. We start moving into consolidation. We'll look at each individual stage in price action as we look at it here. The first one is we have that bullish order block. The price comes back down, snaps right back into it right here. 5 pips added to the level to be a buyer at that point. Again, this is in the London time frame. The next one here is a down candle right at the opening price. In other words, when we find the opening price, and then we're going to be looking for a down candle. That down candle should be seeing capitalization of new longs. We see that come to fruition when the down candle is violated. Okay, so let me go back to this for a moment. We have this down candle here. This becomes an order block that's bullish when this candle trades through it. At a later time, when it hits it here, it can be a buyer, and it has to be below the opening price of that day. Now, it can happen during London or it can happen in New York. Either one is still a good, viable trade. The next day here, we see what price trade below the opening price. We have a small little order block here, and this one here as well, but we're going to say we're not going to worry about that one because we're trading at equilibrium. Okay, we're going to wait for an order block to form, which we see right here. So between this high here and this low here, we're essentially trading at equilibrium. So when we're at equilibrium price points like that, we want to see price give us an order block to give us the justification for wanting to expand higher and away from that equilibrium. You see the down candle here, draw that out in time, price hits it here, add 5 pips to that level, it could be a buyer, price takes off. We have the opening price here, trades just below it here. The down candle at that level. Now notice I'm using a down candle prior to that new day. That's okay. You got to use the previous day's session sometime. The down candle here is where it's being capitalized. They're buying up more of it. So the institutional sponsorship should be justified by saying what? The down candle being violated on the upside, which you see it here. So when price comes back down, it doesn't come right down to on price. I don't want to give you every possible, perfect scenario. And then we see another opening price, trades down, but we get a down candle here, and it's violated on the upside, so this becomes a bullish order block. So you can be a buyer here. So now think in terms of Power 3. Power 3 is the concept I teach as it relates to the daily open, high, low, and close bar. So in other words, a time frame of daily charting. If your minimum trading is trying to capture the bulk of that daily range, you want to be buying near the opening on an up day and exiting on the close. And obviously it sounds like, everyone should know that. But the problem is 99% of everyone doesn't know how to do that. Okay, it's easy to hear conceptually and say, oh yeah, of course, it's obvious. But try doing it. So what I've taught is Power 3 is when you're bullish, you want to be buying near or below the opening price. This scenario, every time it gets you either at, below, or very close to the opening price and allows the range to expand for you and you get a higher close. The reason why we're expecting each day to have a higher close, each day moving from a low up to a higher high, close, from a low to a higher close, a low up to a higher close, a low up to a higher close, a low up to a higher close, and again a low up to a higher close, ultimately a low to a higher close, and then we start a new day here. We can't see it on this chart yet, but look what's happening. Price is being drawn up to that first old high. And look what it does once it gets up at that old high, it starts staying sideways. It's consolidating. Okay? traditional support and resistance players will see that old high as resistance and they'll want to sell short. So what's going to happen? They're going to sell short, sell short, sell short, and they'll see what? Price go nowhere. And their buy stops will be just above this old high. And then you run through them again. They come back down, capitalize new longs, and then extends it up where? To the old high here, the second one. What's happening there? Same scenario. They give you a reason to expect this thing to go lower because it's resistance, old resistance, okay? Should be sold. That's what classic textbooks say. So what's going to happen is they're going to take a short position, put their stop loss, another buy stop, right above this old high. They take those positions out right here. So they're not going to see what? Any lower prices. But we send price back down again into this old order block. Let's take the next slide. So price in here, that's where we just left off at. Price comes back down into that order block here, right there. Rallies up, and now this is where we stop. We stop short of the ultimate terminus or the objective of the price swing. It has a retracement and goes lower. Now this retracement lower will get everybody excited thinking it's been a high formed. Okay, so dollar yen should be trading lower. Get short dollar yen. Everyone's going to have that on the forums. Everyone's going to be talking about it on Twitter, use social media, everything. And it's only just going to go back down to this order block over here. Okay, the same capitalized order block that we saw on this initial run here. Why is this one being used again? Because we have this old area of institutional order flow in the form of the old high. At this point, that's when classic support resistance works. Because why? We have an unfulfilled objective up here with that old higher high. The price comes in, accumulates that same position in here, consolidation, back to the consolidation, expands up off of an order block. But I want you to think about all these down candles in here. All these down candles on a 15-minute time frame creates a larger order block on a higher time frame. Draw that out in time. That's the reason why we're seeing price trade here. So yes, the market opens here, trades lower, closes in the range here, this liquidity void, back into the order block here, and then we have the opening here. It doesn't go lower. Can't do anything with this yet, so it has to expand. So we can't do anything with a buy on this day here. We wait to the next day. The opening, price trades back down, closes in its void, back to an order block here, and in the beginning of all these down candles, that's the buy here. The next one, here's the opening price here. It trades just below it here, but it's dipping into this down candle, which is an order block from the previous day in New York. Okay, so I want you to think about where these order blocks are forming. You're referencing old bullish order blocks from the previous day or maybe 3 sessions ago. And you can buy old bullish order blocks because they're going to do what? Recapitalize them. That's institutional sponsorship. They're defending specific levels. Why should they be defending these particular levels? Because they're vested interested to see it go above that old higher high, where they're ultimately looking to try to take out all of their long positions. Yes, they're going to scale out some here, they're going to scale out some here. They may scale out some above here and here, but ultimately they're trying to drive it up here because that's where a large degree of buyers are going to be. And price ultimately trades down off that candle here and rallies up and ends at terminus. I want you to think about when you're looking at price action, everyone asks for what's the order block to use? Well, it starts with understanding where the market should go. Okay, and that starts by looking at what we talked about in September, which you should be focusing on right now. Down candles right before the up moves, up candles right before the down moves, looking for liquidity voids, looking for old lows to be violated and then rallied off of. That's turtle soup. Or an old high to be rallied through and then rejected and trade softer. That's a turtle soup sell. All these ideas, okay, begin to start taking shape in your price action study, but you have to use specific generic things like time. Every order block that we refer to here is linked to a London session or a New York session. And they're happening from the previous day or a couple days ago. But the idea is they should be capitalized again because there is an underlying interest for the market maker to see price go higher. So they're not going to allow much in way of retracement. But if it retraces, it's going to go back to logical areas in the form of bullish order blocks or running an old low. Now the lows can be, again, the same way, an old previous New York session or London low. They'll take out the sell stops below the lows and then rally it up. The same thing can be seen with the bullish order blocks. You want to be focusing on the London session and the New York session and using these down candles in those previous sessions to give you new buying opportunities. If you're seeing that come to fruition in your charts, you are seeing and identifying institutional sponsorship. Every one of your successful trades will have this hallmark, the characteristic of seeing these recapitalized order blocks and seeing the moves gravitate towards these higher time frame liquidity pools in the form of buy stops for when you're long. When you have that, it makes trading very easy. It allows you to relax and not get so freaked out when you see these retracements like here. Okay, all this is right before the last push up to go to where ultimately the price may go. Now, I don't want to sell the idea that it's always going to go to your levels, okay, because you're going to have to do a lot of learning, studying these ideas. But I want you to focus primarily on the characteristics I've shown you here. Specific order blocks that take place at London and New York, okay, they will help you discern whether there is institutional sponsorship in your particular trade. If you see the lack of that, chances are you're probably offside and you're either going to want to reduce the risk on the trade or maybe go to the sidelines and wait for another opportunity. Until the next time, wish you good luck. Okay, folks, welcome back. This is the fourth teaching of 8 of the November 2016 content, the ICT mentorship. We're going to talk about some anticipatory skill sets, and one of the skill sets that I teach is using the monthly chart. But this teaching is going to be specifically dealing with using institutional order flow to help you find new setups. When we look at the monthly chart, the first thing you gotta remember is remind yourself that the monthly chart is only going to move with a great deal of money behind these price swings, and retail's not going to have it. The idea of seeing big ranges on a monthly chart, that's going to be a result of enormous amounts of buying or selling interest by the smart money. Again, retail can't move price, so if we can see where they're most likely going to place orders to buy or sell, and we can see on the monthly chart, we stand to make a great deal of pips, and we don't have to trade a whole lot to do it. But I want you to think about the opens, the highs, the close, and the low of every single candle on a monthly chart over the last few months. Every pair that you have on your platform. This is a good study, not to trade every single pair, but I want you to go back over every pair you think is of interest to you and have the open, high, low, and close delineated on a monthly chart over the last 3 months. So that would look like this. We're in November now. So here's October, September, August, and having those reference points on your chart and having those levels transposed into your lower time frames, they'll bring a great deal of clarity. Now you may have a few overlapping levels like this chart. We have a couple different opens and closes that are real close to proximity. That's okay. But I want you to find the most recent down candle. That would be this one here. There you go. And then prior to this down candle, what up candle exists above it? So in other words, if it's at the down candle, you got to go above its high. So its high is, I can get it to show up. Okay, the high is 31.44. So we have to have an up candle or an up close candle that has at least a low that's higher than 31.44. Obviously, it's right here. Just that quick, we've delineated a range on the monthly chart. Now, by itself, you've done a great deal already, but I know you don't believe it. You have to see it to have faith in it. So what we defined is the range in which we're going to trade in. If I take these two reference points and I drop them down into a weekly chart, okay, by having it on a weekly chart, we can have a lot more information refined. And let's delineate this month here with the vertical line on the month prior to it. So now we have a down candle to the right of this vertical red line. So we're looking at June. This is June having a down close. So if we go into a daily chart, a weekly chart, okay, we have price still in a long-term consolidation, many weeks going by here. And these two down candles here, price trades through it on this candle here. So now we have activated to use two down candles as a bullish order block. We have upside movement here. It violates the two down candles. So now we can see price return back down into it. It would be a bullish scenario. Notice also that the monthly candle at 130.70, we'll call it 130.80. Let's round it to 130.80. That's close enough for government work. Price drops down into that a couple different times, and you see price is expanded. Now the upside is still that monthly bearish order block. It's also the beginning of the last three candles that were up, the same as this up candle's low. You can see price, and you can probably already visualize it reaching for this, probably going into next week or the week after. We'll probably see more continuation of the upside. We go into a daily chart. Okay, you can see the vertical lines delineate each month. You see price dipping down into that monthly open that we rounded up to 130.80. Price responds aggressively off of that. And then we have the beginning of this decline here in October. And this is the reason why, and it sounds like hindsight if you're watching this without having the benefit of being a part of the live sessions and watching the recordings over the last week. But we looked at 132.80 as a downside objective. And the reason why that was objective was based on these two down candles here. And the fact that we are looking for higher prices relative to what's been shown on monthly. Okay, so we see price retreating back into this down candle multiple times right here on this one, and then ultimately retreating down into the higher level, 32.80 level. Right in here. And you can see price expanding on the upside. So we're looking for 138 big figure and potentially higher than that. The takeaway is this: if you look at your monthly charts, okay, and you define where you're at presently in the range, all you have to do is find the most recent down candle and the most recent up candle, and there's your range. If you get the market trade above a down candle, you wait for a return back to that down candle to trade up into the last up candle. If you have a market trade up into a up candle, you find the last down candle, most recent down candle, which will be over here. That would be your range for the downside. So we still have upside still to go for dollar CAD on a monthly basis. Let's look at this same example of study on a US Japanese yen pair. Okay, we have the most recent down candle here. And prior to this down candle, you have to have a candle that's higher than the candle's high, which is 104.35. So above here, to the left, where's the up candle? It's here. There's your range. So between 106.28 and 103.26. So basically 300 pips. The idea is as soon as this candle trades above the down candle's high, this down candle becomes a bullish order block. So we can be a buyer at 103.26 or less. You drop into a weekly chart. Here's price trading below 103.26, and again here on the US election, trading down into the bullish block here. We go into a daily chart. You see the body of this down candle. It's larger than this one here. So this is the beginning of the bullish order block. There. And mean threshold of this down candle will be about right here. And it's not even challenged at all here, even on the election knee-jerk reaction. So price dips down into it here. This would be a buy. It starts to rally away, then opens on the election, trades down into previous bullish order block. This will be another buy and rallying away. We have old highs back here, and we have equal highs back here. On the monthly chart, this is the objective we would be reaching up to, and we've already seen that happen with 300 pips plus. Let's use Kiwi dollar. And go to a monthly. Okay, so we have the last down candle here, and the most recent up candle here. Okay, and we've moved away from the last up candle, exercising this as a bearish order block. We go down to a weekly. Okay, you see price trading up into bearish order block. It does trade through the body of this candle, but it's rather sloppy right now. The downside objective is 69.83, so 69.85. The buy to these candles here, close comes in at 70.05, so that would probably be where I'd be looking to cover. It's about 120 pips or so. Still potential downside objective. And personally, on the side now, I think it's going to go down here to 67.80. And on the daily time frame, you see price has in fact already moved a good distance. Now this is the bearish order block up in here. So anything above that price had reached up into, you can refine that into a lower level time frame bearish order block. See it trading in here. Minimum expectation is to trade down to here. The next one would be down here. So you're going to reach for that. And then below these lows. Okay, so we're using the monthly chart to give us our bullish and bearish order blocks and define our range. And then we look for lower time frames to get closer to the market and refine our risk. Use the higher time frame monthly chart. Find the most recent up candle and the most recent down candle. There's your range. Define that range in terms of where the most recent order flow has sent price. Was it violating close or a down candle, which gives that permission to become a bullish order block, or has price broken an up candle by violating its low, which then activates that as a bearish order block? You just simply look for the contrarian order block on the monthly chart. And you take those levels and you find them down into a weekly, into a daily, and down to an hourly chart. And you can see there's a plethora of opportunities to study with all these different pairs. And it gives you a context to actually look into the marketplace with a specific mindset, not just waiting for a neon sign to jump off at you and saying, okay, I wonder what I should do today. You'll know what levels to trade off of relative to the monthly chart. And it's basically a top-down approach that leads you right into trade setups that you otherwise wouldn't know they were there. Okay, folks, welcome back to the fifth of 8 teachings for the month of November 2016 ICT membership. Okay, we're looking at inside price action, institutional market structure. Okay, now what is institutional market structure? It's the analysis of correlated assets with a relationship to inversely correlated assets. The purpose is to determine what the smart money is accumulating or distributing. Now, currencies are the easiest to analyze with institutional market structure, and we utilize the dollar index. Every price swing should be studied to determine if market symmetry confirms it. Now, how do we identify institutional market structure in Forex? the dollar index of the foreign currency that we trade. As the US dollar index trades higher, we reasonably expect a lower price swing in foreign currency pairs. If fails to move symmetrically, smart money is actively trading. As the US dollar index trades lower, we reasonably expect a higher price swing in foreign currency pairs. If the US dollar index or foreign currency fails to move symmetrically, again, smart money is actively trading. Okay, let's take a closer look about what this concept actually means. And we're going to be referring to the US dollar index SMT divergence. Now, SMT stands for Smart Money Tool or Smart Money Technique. And we're going to be looking for a divergence between closely correlated or inversely correlated assets. Now, obviously, if we expect the dollar index to trade higher, that's going to put downward pressure on foreign currencies. If we're expecting the dollar index to trade lower, that's going to allow foreign currencies to rally. In a symmetrical market condition, when the dollar index makes a lower low, foreign currencies, we expect that to make a higher high. When we see this, this confirms current price action, and the underlying trend is likely to continue. Now, the idea of stalking reversal pattern in this condition is not highly probable. In fact, we want to avoid it altogether. The reason why is because, for instance, let's take a look at the dollar index example here with the red line. Okay, we're going to look at the likelihood of that old low being violated, as we see here. And if we see that old low violated, and we see a higher high in foreign currency, that confirms the down move in the dollar index. And even though it trades back above a short-term high, that short-term high is going to be just a run on buy stops. And then the dollar index most likely will resume going lower. This is one of the ways that I can basically go into the marketplace and anticipate a turtle soup before it actually happens. And the same thing is said for foreign currencies. If we see that higher high, while the dollar index makes that lower low, price is confirmed. That means the underlying direction is still intact. So any movement down in the foreign currency pairs below a swing low or a short-term low, they're gathering up the sell stops below the marketplace, and that's what they're going to be accumulating new long positions, and then the foreign currency pairs will be allowed to trade higher and new higher high. Now, when the dollar index makes a higher high and the foreign currency makes a lower low, this too confirms current price action, and the underlying trend is likely to continue. Again, like we just said about the other slide, the idea of stalking reversal patterns in this condition is not high probability, and it should be avoided. Again, once that dollar index makes a higher high and the foreign currency makes a lower low, that run above the short-term high in foreign currencies is many times going to be a run on the buy stops in the marketplace, and then you'll see another sell-off making a lower low. And the same is said the contrary, the dollar index, when the market trades back below that short-term low, it's going to gather up, sell stops to pair new buying with, and then it'll most likely trade higher and make a new higher high. Now we're going to talk about non-symmetrical market conditions. When the dollar index makes a lower low and the foreign currency fails to trade higher than a previous high, this is US dollar index SMT or USDX SMT. This does not confirm current price action, and the underlying trend is likely not to continue. However, the idea of stalking reversal patterns in this condition is high probability and could reasonably be considered. That lower low on foreign currencies is indicating that the dollar index is most likely going down below a previous low to do what? Wipe out the sell stops, accumulate new buying, and the rally should ensue in the dollar. If the dollar is going to rally, that means it's going to be downward pressure in foreign currencies, and it's already shown itself in the form of weakness by having a failure swing in the foreign currency making a lower high. Again, looking at non-symmetrical market conditions, when the dollar index fails to make a higher high, while foreign currencies make a lower low, the same thing is being said as we said in the previous slide. It's just being illustrated in a different context. This is showing the dollar index is failing to make a higher high. That means there's underlying weakness. And there's a lower low seen in foreign currency pairs. They're going down below a previous low to accumulate all the sell stops on foreign currency pairs. Then they'll rally the market higher. The dollar index will sell off, which would support foreign currency long positions, and the underlying weakness is indicated with the US dollar index making a lower high, fuels those market moves. The idea of stalking reversal patterns in this condition is high probability and could reasonably be considered. Okay, so let's take a look at a case study here. What does this look like in price? Okay, we're looking at a daily chart of the British pound USD, or as we call it, the cable. And notice the highs in here. That we have higher high formed in pound dollar. This is around the end of April going into mid-June of 2016. In the same time frame, we see the dollar index making a low in April time period going into mid-June. But notice the difference between the two. Going back to the pound dollar, we have a higher high forming in the middle part of June 2016. By itself, at the time when it was rallying up, I'm sure it probably looked very positive and bullish to everyone. But if that's the case, if there is a symmetrical market condition, that should be seen with what in terms of the dollar? It should be seen with a lower low. Do we see a lower low form in the dollar index? No. That's a USDX SMT bullish divergence. That means what? We're seeing underlying strength in the dollar index, and even though this looks bullish on the British pound, it's really just taking the buy stops above the 47.60 level. Once those stops are ran out, the market does in fact tank. The underlying strength in the dollar index allows us to look at that 93.80 at a 94 big figure, this down candle here, that may become a future bullish order block that we could trade at. Once this void is closed in, we know that there's underlying strength in the dollar index because there was an unwillingness to see that lower low form as we saw the higher high form in cable. So again, you can see that that higher high piercing an old high, that's going to be a run on stops above that 47.60 level. Now it trades almost up into 50.65, which is like several hundred pips, but it's a daily chart. So we're going to be cognizant of that, but nonetheless, we're looking for institutional market structure. So this looks like, by all indications, when the market was rallying up, retail traders and less informed traders would see that as a bullish breakout, but it's not seen with the dollar index having a lower low. We see the same thing we mentioned earlier, just graphically described here, a higher low formed on the dollar index. That should have created a lower low as the cable made a higher high, and it didn't. What is that actually giving us? It's giving us a great insight about what is being accumulated. The dollar index is being accumulated on the long side. Otherwise, it would have been permitted to go lower. If we see that, and we can see a foreign currency pair shooting higher, okay, basically acting on its own accord, if you will, okay, that's not by accident. It's absolutely a manipulation. So if we understand where the manipulation is taking place in the marketplace, then we can go in and capitalize on that. So now we can focus primarily on being bullish dollar. Why? Because the dollar was unwilling to make a lower low. And the only reason why that can happen is that it's being bought aggressively. Otherwise, they would wait for lower prices. So since they're unwilling to wait for lower prices in the middle of June of 2016, we have to focus primarily on being a buyer on dollar. And that means put sell signals or bear stance on all foreign currencies, looking to be a seller. This is the reason why all through the second part of 2016, I've been dollar bull. Okay, let's take a look at another example. And we're going to be using the daily chart again, because I want to build the idea that you don't have to be a day trader, but having these ideas will help us have a long-term to intermediate term perspective of the marketplace. So I'm going to turn our attention to the latter portion of August 2016 to the first week of September. And you can see that the cable made a higher high. Okay, so all indications here looked very bullish. Okay, so price was running through an old high here. At the same time, this low on the dollar index here did not see another lower low. So as the cable was pressing higher, rallying, this dollar index should have seen a lower low. It did not do that. What that indicates is, again, dollar-based strength. In other words, the dollar index is being accumulated on the long side. The cable is being distributed. Now it's being distributed above an old high here, but look to the left again, above this old high here as well. So now we can go and frame another level for turtle soup, for a false break above an old high to run what? What type of stops reside above an old high? Buy stops. Why would they want to take the market up to a buy stop? Because they want that buy stop to execute at the market, to buy at the market. They're going to sell their long positions they accumulated here and they accumulated here. They can sell their longs at a higher price to willing buyers up here. This is being distributed. It's being distributed at an old high while the accumulation is seen in strength because the dollar can't go lower. Now think, if the dollar doesn't go lower, it's because it can't go lower because of pricing. It's being kept while the premium is being built into the pound dollar. So retail chases this run like this and false breakout, while smart money looks at failure swings and the lows. When you see what would otherwise look like strength and breakouts on the upside in foreign currencies, always double check them with the dollar index. If you don't see that, then you know that the false breakout on the upside in the foreign currency market, it's all sucker play. It's retail candy land. Everyone's going to be looking to be going long on those false breakouts in foreign currencies, while the smart money is focused in on the dollar, having an unwillingness to go lower like it does here to this low. And I basically framed the exact dates. That's why this box is up here. So it's not like a kill zone or anything like that. I'm just giving you a specific date range to look at sample size of price action. As you look at this, I want you to see just how strong it is in terms of giving us a long-term to intermediate term perspective on what direction the market is going. Again, this is a daily chart. So if they're going to keep price at a higher price low here and not blow out the previous low or this low over here, we see the unwillingness to hold these prices in British pound USD. They quickly drop it lower because it's been distributed. They left the retail holding the bag. When accumulated long positions start moving higher, every time there's a retracement, we expect to see another expansion on the upside. So when we look at price like this, we can see it graphically using the price chart, but I also use a tool as an overlay for the MT4 platform. And I'm going to show that to you now. Okay, here we are over at the ICT Monthly Mentorship forum. And we're in the November content thread, or category as the forum calls it. Okay, and I gave you several MT4 indicators today at the time of this recording. And what I'm going to do is I'm going to tell you what we're going to be doing is showing you how to install this on MT4. Now, it used to be where you could just download an MT4 indicator and just drop it in the indicator folder. They have since changed that with MT4 and made it a little bit more difficult. So it's not that difficult, but it's a little bit tricky. So what we're going to do is we're going to click on the link, the MT4 line chart overlay. By clicking on that, it's giving you a download. I go down here, I save it as Unicode, and you would just go up into Insert, go down to Indicators, and go to Custom, and scroll down to Overlay Chart Line. Click on that. Where it says all these double X's. Double click on that, and what you're going to be doing is changing that to whatever pair or the dollar index you want to use. And I'll show you what I mean by that. Let's go back and highlight a specific chart first. So we're highlighting the British pound USD chart by clicking anywhere on the chart. Go up to Insert, Indicators, Custom, Overlay Chart Line rather. Double click, and we're going to be overlaying the US dollar index, so capital letters. Okay, and we're going to leave everything as it is here. I have a white background, so I will just change it to that. And close, and suddenly it's gone. It makes it real clean and be able to see it very crisp. Now you can do all of your notations for your log when you're done doing your trades or as you're doing your analysis. So while we're seeing higher highs here, dollar index is making that higher low. So it should have been a lower low there. It has not shown that as confirmation. So we see that as a turtle soup or a false breakout of high and an old high here. So we can look for that to be distributed. We do not see that as strength. Okay. And then obviously the market trades softer. So when we look at identifying institutional market structure, what we're basically doing is we're weighing the underlying strength of the buying and the selling at respective highs and lows in the dollar index versus foreign currencies. Now, if you pick one particular currency pair and you identify areas like this and test on a daily chart, it gives you a long-term perspective where you can focus primarily on being short. That means if you are a short-term trader, you could be looking to sell short at every 60-minute or 4-hour bearish order block. Or you could be a day trader selling it above the opening price, above the midnight candle in New York. And you just capture all those types of moves going lower. So it gives you an ideal context to work within and gives you a framework. it doesn't give you ambiguity. It gives you a very specific frame of mindset going in, knowing that if it's the daily chart and we're seeing underlying strength in the dollar and we're seeing potential distribution in British pound USD, most likely we're going to see lower prices on cable. So that way we can be a buyer on dollar-based currencies or a seller on foreign currencies that is paired up with the dollar index. So hopefully you found this insightful. Until next time. Welcome back, folks. This is the 6th of 8 teachings in the November 2016 curriculum of the ICT mentorship. And we'll be teaching the macroeconomic to micro-technical, macroeconomic to the micro-technical, macroeconomic to the micro-technical. Okay, and I'm showing you here one of the secrets to how I'm able to call the markets as I do. And it's a macro perspective, so in other words, it's not a day trading perspective. It's not something that's going to be forcing you to look at 15-minute charts, not even an hourly chart, not even a 4-hour chart. Okay, we're going to be looking at daily charts only. And you probably are wondering, why is there a top secret image here at the bottom? Well, below this cover is going to be one of the closest guarded secrets of my repertoire. And when I look at the marketplace, I use this as a barometer to help me determine where the long-term trend of the marketplace is going. Now, there's a lot of folks that will scour bank reports, and my opinion of bank reports are this. Why would a bank tell you what their intentions are? It doesn't make any sense. That's like having a football team tell you what their plays are going to be for the Super Bowl. It just doesn't happen. So when I look at the marketplace and I'm looking for a long-term macro view, I'm looking for an insight that would give me a 3 to 6 month outlook on where currencies may be heading in what direction. And one of the things I use for that is interest rates. And the way we find interest rates, the way I do it, is I'm looking at the bond market. The 30-year Treasury market will give me the insights I need for interest rates on an intermediate to long-term basis. Long-term to me is 3 to 6 months. It may not be long-term for you, but it is for me. So what I look for is every three to 4 months, there is a quarterly shift that takes place. And what I mean by that is whatever trend or whatever market condition is prevalent for right now, in 3 to 4 months time, there's usually a shift. Okay, there's either a reversal or it's an extended period of consolidation, and then a future resumption of the trend, or again, a reversal. But every 3 to 4 months, I'm looking for a change in direction, because I believe there is a quarterly shift that takes place in the marketplace, and you'll learn a lot about that later on in this mentorship. But for now, I want to teach you how I use the bond market and how I use the interest rates as a precursor for where the markets may go. I don't require a whole lot of fundamental data to sift through. I don't believe I have enough time in the day to go through all that. I know there's a lot of folks that would probably hear me say that and scoff at the notion that fundamentals are that's the backbone to the marketplace. You need to know those things, and my submission to that is who can keep up with that? I don't have time to keep up with it. I'm busy running a life. I don't have the time to be sifting through all that information, and quite frankly, I'm not that astute to be able to discern what that data is. So what I require is a visual interpretation of that data, and what I subscribe to is the bond market will tell me that. If I can read price action in the bond market, and not just the bond market, but we're going to look at the 10-year moves as well. If we can get a feel for what the bond market's wanting to do, whether we trade higher or lower, then we can have a pretty good basis on what the interest rate market's going to do. Okay, so what we're looking at is about June, July, August time period. Okay, June, July, August time period. The top chart here is obviously the dollar index daily chart. And the lower chart is the Treasury bond market. This is the December contract. Okay, so December contract for the dollar index above us in the futures market, and the December contract for the bond market on the lower end. Okay, so the lower chart is the bond market. Between July and August, there was a high that formed in the bond market. And for those that follow along on a Twitter and on my YouTube channel, this summer I mentioned that the debt market is going to have a major decline. And I said that was going to happen. I also said it was going to happen in the bond. I said it would happen across all of the debt instruments. So basically, what I was implying was that interest rates were going to go higher. If interest rates are going to go higher, that's going to allow the dollar index to go higher. Okay, but when interest rates are going higher, that means that the bond market is going to drop. As the bond that's a lowering of interest rates. And when it drops down in the futures market for the bond market, that is an increase in interest rates. Okay, now 30 Treasury bond is the benchmark for what we have in the U.S. as our mortgage rate. We put a house on the market for purchase. If someone wants to ball and chain debt program to pay off a house for 30 years. The interest rate that's arrived at this market pretty much is the benchmark for it. There's another interest rate asset market that I look at, which is the 10-year. And I look at that. We'll look at that later on in this teaching here. But what I want you to look at is when the bond market is creating a high here. Okay, at the same time that the dollar index is making a low. Okay, I want you to take a look at what's going on here. In the last week of June, we have the dollar index making a low, and the market failed to make a lower low at the same time that the bond market was making a higher high. Now, in lesson 5 of this month's teaching, I taught you the SMT divergence relative to the dollar index and foreign currencies. That same idea is applied here but for an interest rate divergence. In other words, we're looking at how the bond market interacts with the dollar index. So around every 3 to 4 months, there's going to be this shift that takes place. This underlying change in trend is seen in the dollar index with the failure to make a lower low. At the same time, the bond market made a higher high. Market traded softer. At the same time, all the way into the last week, midway point of August, we saw consolidation in the bond market as well. Then we saw the movement higher on the dollar index. At the same time, we were seeing weakness in the bond market, which means interest rates are increasing, which means now we have the dollar index going back into a down candle, which is a bullish order block. So we can expect to see prices may move higher on the dollar, which will do what? Send the bond market lower. So when we see this rally up, it's returning back to an up candle, which is a bearish order block, and it sells off again. This sell-off, okay, accelerates the buying in the dollar. So if the dollar is going to accelerate going higher, let's go back to this time period here, okay, and reflect on the analysis I was given in the mentorship. You all know that I was looking at this particular time period right here on the dollar, and I said that we were going to start going higher, and we're going to be looking for that $1 mark, potentially 102 mark. And the reason why I suspected that was going to happen is, number one, I was looking at the dollar pairs that are started with the USD as in their name. In other words, like dollar CAD, dollar Swissy, dollar yen. I was looking at the dollar CAD, and it just supported the idea that we were going to go long here, or we're starting to go higher. At the same time, the bond market was rallying up, returning back to a bearish order block. So I knew what to expect was to see if we turn the tide here and start going lower on bonds, that drop down in bonds is an increase in interest rates. An increase in interest rates is going to see a aggressive pouring in of funds to buy up the dollar. So that's what we're seeing here, that aggressive rally up. The market showed a willingness to drop even lower here on the bond market. At the same time, there was a small little decline at the same time when the bond market was dropping. Small little deviation from what would be considered the normal. That was all attributed to what? The U.S. elections. Nobody knew what to expect with the elections, except for ICT. He said Trump was going to win. So obviously Trump won. Overnight, the futures market were tanking, and the dollar index sank, and the Dow Jones futures were down like 750 points at one time overnight. And all of a sudden, the very next morning, everything was peaches and cream, and it's been rocketing up since. In 10 days in a row, the market's been rallying up for the dollar index. At the same time, we've seen an accelerated sell-off in the bond market, which means there's an increase in interest rates. So when we look at the marketplace like this, utilizing the bond market to help us, we can use that same idea as it relates to looking at divergence between the bond market and the dollar index. So with that said, I'm not going to go into great detail because obviously you know what I mean by that, but using what was taught to you in the 5th teaching of this month's content. Okay, folks, we have the 10-year note to the left and a 30-year bond to the right. Okay, and I want you to take a look at the SMT divergence that we have in these two charts. Okay, and I want to take a look at the currency markets and see how that assisted us in analysis. Again, this is a long-term to intermediate-term concept. So it's aimed at giving you the next 3 to 6 months outlook on where currency should be going. Okay, so take a look at the 10-year note here, making a higher high here. At the same time, 30-year made a lower, bond market took off lower. So the second week of September, we saw interest rates increasing by the effects of the bond market and 10-year note declining. Then we saw the last week of September going into October, we saw this higher high form in the 10-year, while we saw a lower high for SMT divergence in the 30-year. And then immediately we saw another decline in both 10-year and 30-year, which is an increase in interest rates. So right away we know that there should be an accelerated buy or a rally in the second week of September and the last week of September for the dollar. So let's take a look at that. Okay, we can see here the dollar index, first week of September. Here's that low we would expect because we saw an increase in interest rates as a result of the sell-off with the divergence between the 10-year and the 30-year market. And in the last week of September, we saw the market make a rally away from that point as well. So we have a rally here and a rally here, and it begins that big movement higher. Now, if we in the dollar index, we should be seeing rallies in dollar Swiss. Here's September, this month here, first week of September, it rallies. Last week of September, it rallies. So we see that same effect appearing as well in that dollar pair. Let's take a look at the dollar CAD. Here's September, the first week of September, it rallies, and it's at last week to this month of September, it rallies again as well. Let's take a look at the euro. This is going to be the opposite. We're going to see a high form the first week of September. There we are. And then it sells up again the last week of September. And there you go. Rolls over. The pound, we should be seeing a high form in the second week of September and a sell off the last week of September. So a high here and a high here and an accelerated sell off. Okay, that was the reason why also I told you we were going to be looking for these lows to be violated. That was all behind the scenes why I was calling that move here. Okay, and which also led to our target, or my target that I shared on Twitter and on YouTube. It's still on my YouTube channel videos calling for the 120 level for British pound before the Brexit. So, and we'll add one more. Let's take a look at the dollar yen. Okay, and we have a low that formed in the first week of September. In the last week of September, there's that high, and it takes off, and it's taken off extremely high. So again, it's a macro perspective using macroeconomic principles, interest rates, okay, and then utilizing that down to a micro technical. So we can take all this information, okay, and from the month of September, start looking for reason to be a buyer for all the dollar-based currencies that start with the dollar first in their name. We would be going long those pairs. New Zealand dollar, we should be seeing a sell-off around the first, second week of the month. We see it here. Last week of the month, we see it here. And Aussie, we should be seeing a sell-off the first week of the month here. And the last week of the month here, you see that as well. Okay, so again, it helps you, it builds an idea about where the market should go because of the underlying fundamentals, which I don't have to go through fundamental reports to do all that. I can rely on the interest rate markets that I know, which is the bond market and the 10-year note. Couple that with the dollar index, it's like the pins in the lock turn for you, and no one can take it from you. So let's go back to the 10-year and the 30-year note. Okay, now we're going to take a look at the rally higher here on the 10-year. That was not seen here on the 30-year. So we know that there's going to be an accelerated rally on the dollar index the first week of November, obviously post US elections. And let's go back to our dollar index chart. Now we see November, we made that lower low. So that whole overnight fiasco with the sell-off on the dollar and the Dow Jones was all fluff. It was all manipulation. because we see that lower low here in dollar, but we did not see it in higher highs seen in the 10-year and 30-year futures on the debt instruments. So interest rates were calling the shots still, even though short-term hard tack on the charts in this down move here on the dollar and Dow Jones overnight, the day of the election, everything was put back in gear longer term with the acceleration on the up move on the dollar rally, chasing higher yields. And you can see that also in the form of dollar Swiss, dollar CAD, weakness, even though it looks like it's strength above an old high. Remember, that's a false movement we look for. SMT is telling you it looks bullish with the underlying tone of the marketplace. There's no way the dollar is going to allow Aussie dollar to rally. And that's why we're seeing it get up the ghost. Same thing with the New Zealand dollar. It looks bullish starting off running, just taking out an old high and running down lower. The dollar CAD accelerated to the upside. Euro as well, that initial run up, clearing an area of buy stops we talked about during this mentorship here. Hit 113 big figure, and it's been slamming lower since. So I hope you take this information, keep it close to your vest. In other words, don't share it with the general public. Most people will never learn this tactic. I don't have a source to be able to say I learned it from this one or that one. It was just me understanding the bond market as a futures trader and understanding that the interest rate markets just basically control everything around the world. Okay, it makes everything go. In the financial industry, if we can get a feel for what the bond market's wanting to do, whether we trade higher or lower, then we can have a pretty good basis on what the interest rate market's going to do. Okay, so what we're looking at is about June, July, August time period. Okay, June, July, August time period. The top chart here is obviously the dollar index daily chart, and the lower chart is the Treasury bond market. This is the December contract. Okay, so December contract for the dollar index above us in the futures market, and the December contract for the bond market on the lower end. Okay, so the lower chart is the bond market. Between July and August, there was a high that formed in the bond market. And for those that follow along on a Twitter and on my YouTube channel, this summer I mentioned that the debt market is going to have a major decline. And I said that was going to happen. I also said it was going to happen in the bond. I said it would happen across all the debt instruments. So basically, what I was implying was that interest rates were going to go higher. If interest rates are going to go higher, that's going to allow the dollar index to go higher. Okay, but when interest rates are going higher, that means that the bond market is going to drop. As the bond market rallies, that's a lowering of interest rates. And when it drops down in the futures market for the bond market, that is an increase in interest rates. Okay, now the 30-year Treasury bond is the benchmark for what we have in the U.S. as our mortgage rate. We put a house on the market for purchase. If someone wants to ball and chain debt program to pay off a house for 30 years, the interest rate that's arrived at this market pretty much is the benchmark for it. There's another interest rate market that I look at, which is the 10-year. And look at that. We'll look at that later on in this teaching here. But what I want you to look at is when the bond market is creating a high here. Okay. At the same time that the dollar index is making a low. Okay. I want you to take a look at what's going on here. In the last week of June, we have the dollar index making a low. And the market failed to make a lower low at the same time that the bond market was making a higher high. Now, in lesson 5 of this month's teaching, I taught you the SMT divergence relative to the dollar index and foreign currencies. That same idea is applied here but for an interest rate divergence. In other words, we're looking at how the bond market interacts with the dollar index. So around every 3 to 4 months, there's going to be this shift that takes place. This underlying change in trend is seen in the dollar index with the failure to make a lower low. At the same time, the bond market made a higher high. Market traded softer. At the same time, all the way into the last week, midway point of August, we saw consolidation in the bond market as well. Then we saw what? The movement higher on the dollar index. At the same time, we were seeing weakness in the bond market, which means interest rates are increasing, which means now we have the dollar index going back into a down candle, which is a bullish order block. So we can expect to see prices may move higher on the dollar, which will do what? Send the bond market lower. So when we see this rally up, it's returning back to an up candle, which is a bearish order block, and it sells off again. This sell-off, okay, accelerates the buying in the dollar. So if the dollar is going to accelerate going higher, let's go back to this time period here, okay, and reflect on the analysis I was given in the mentorship. You all know that I was looking at this particular time period right here on the dollar, and I said that we were going to start going higher, and we're going to be looking for that $1 mark, potentially 102 mark. And the reason why I suspected that was going to happen is, number one, I was looking at the dollar pairs that are started with the USD as in their name. In other words, like dollar CAD, dollar Swissy, dollar yen. I was looking at the dollar CAD, and it just supported the idea that we were going to go long here, or we're starting to go higher. At the same time, the bond market was rallying up, returning back to a bearish order block. So I knew what to expect was to see if we turn the tide here and start going lower on bonds, that drop down in bonds is an increase in interest rates. An increase in interest rates is going to see a aggressive pouring in of funds to buy up the dollar. So that's what we're seeing here, that aggressive rally up. The market showed a willingness to drop even lower here on the bond market. At the same time, there was a small little decline at the same time when the bond market was dropping. Small little deviation from what would be considered the normal. That was all attributed to what? The U.S. elections. Nobody knew what to expect at the elections, except for ICT. He said Trump was going to win. So obviously Trump won. Overnight, the futures market were tanking, and the dollar index sank, and the Dow Jones futures were down like 750 points at one time overnight. And then all of a sudden, the very next morning, everything was peaches and cream, and it's been rocketing up since. And then 10 days in a row, the market's been rallying up for the dollar index. At the same time, we've seen an accelerated sell-off in the bond market, which means there's an increase in interest rates. So when we look at the marketplace like this, utilizing the bond market to help us, we can use that same idea as it relates to looking at divergence between the bond market and the dollar index. So with that said, I'm not going to go into great detail because obviously you know what I mean by that, but using what was taught to you in the 5th teaching of this month's content. Okay, folks, we have the 10-year note to the left and a 30-year bond to the right. Okay, and I want you to take a look at the SMT divergence that we have in these two charts. Okay, and I'm going to take a look at the currency markets and see how that assisted us in analysis. Again, this is a long-term to intermediate-term concept. So it's aimed at giving you the next 3 to 6 months outlook on where currency should be going. Okay, so take a look at the 10-year note here, making a higher high here. At the same time, 30-year made a lower, bond market took off lower. So the second week of September, we saw interest rates increasing by the effects of the bond market and the 10-year note declining. Then we saw the last week of September going into October, we saw this higher high form in the 10-year, while we saw a lower high for SMT divergence in the 30-year. And then immediately we saw another decline in both 10-year and 30-year, which is an increase in interest rates. So right away we know that there should be an accelerated buy or a rally in the second week of September and the last week of September for the dollar. So let's take a look at that. Okay, we can see here the dollar index, first week of September. Here's that low we would expect because we saw an increase in interest rates as a result of the sell-off with the divergence between the 10-year and the 30-year market. And in the last week of September, we saw the market make a rally away from that point as well. So we have a rally here and a rally here, and it begins that big movement higher. Now, if we see that in the dollar index, we should be seeing rallies in dollar Swiss. Here's September, this month here, first week of September, it rallies. Last week of September, it rallies. So we see that same effect appearing as well in that dollar pair. Let's take a look at the dollar CAD. Here's September, the first week of September, it rallies, and it's a last week to this month of September, it rallied again as well. Let's take a look at the euro. This is going to be the opposite. We're going to see a high form the first week of September. Here we are. And then it sells up again the last week of September, and there you go. Rolls over. The pound, we should be seeing a high form